Let's talk about Shell, a global energy giant with a presence in nearly every corner of the world. From fueling cars and planes to powering homes and industries, Shell's operations touch billions of lives every day. The financial decisions Shell makes don't just affect its own bottom line. They ripple across the world, influencing global markets, energy prices, and even government policies. Their financial statements are massive, complex, and crucial for investors, governments, and the public. Every number tells a story about profits, risks, and the future of energy. Enter Ernst & Young, or EY, one of the Big Four accounting firms, the trusted referees of the corporate world. These firms are called in to make sure the financial story companies tell is true and fair. Their job: audit companies like Shell and confirm if the numbers add up. They dig deep into the books, ask tough questions, and look for anything that doesn't add up. This process, called an audit, is the backbone of trust in our financial system. It's what gives investors, employees, and the public confidence that the numbers are real. One company makes the money, the other checks the math. So everyone can believe the numbers. It's a system built on checks, balances, and professional skepticism. But what happens when the referee misses a key rule? When the watchdog falls asleep, even for a moment, the consequences can be huge. That's what's happened here. The UK's financial watchdog is investigating whether EY failed to follow a crucial rule while auditing Shell. This isn't just a technicality, it's a question of whether the system worked as it should. This isn't just an accounting squabble, it's about the trust that underpins our markets. Billions of dollars and the confidence of millions are at stake. When you buy a share, you trust the information is accurate because of audits. You believe that someone independent has checked the numbers and given them a stamp of approval. If the audit process is flawed, even slightly, it shakes that foundation. Doubt creeps in, and trust begins to erode. And, as we'll see, even small cracks can lead to big consequences. Official investigations, headaches, and some very awkward press releases. The fallout can last for years, affecting reputations and careers. Let's dig into how this all unfolded and why it matters for anyone who cares about the integrity of our financial system. So, what's an audit? Think of it like a mechanic checking a used car before you buy it. In business, an audit is an independent check of a company's financial records. Firms like EY dig through invoices, contracts, and bank statements to verify the numbers. Their goal: provide assurance that the financial statements are free from big errors or fraud. After their review, they issue an audit opinion. Basically, a report card for the company's finances. Why bother? Because without audits, companies could say anything and no one would know the truth. Audits protect against fraud and give investors confidence to trust a business. For a giant like Shell, a mistake could shake global markets. That's why audit rules are strict, and why firms like EY are held to such high standards. Now, let's talk about audit partner rotation, a rule that keeps auditors independent. If the same person audits a company for years, they might get too cozy and lose objectivity. To prevent this, regulators require lead audit partners to rotate off after a set number of years. In the US, it's 5 years on, 5 years off. In the UK, similar rules apply. This forces fresh eyes onto the audit, ensuring skepticism and independence. It's not just a suggestion, it's a hard requirement. For investors, it's reassurance that audits aren't just rubber stamps. Breaking this rule isn't a minor slip. It calls the whole audit into question. That's exactly the mess EY and Shell are in now. The integrity of the audit process depends on these safeguards. When they're ignored, trust in the system is at risk. So, what went wrong? EY discovered its own mistake. One of its audit partners had stayed on Shell's audit too long, breaking the rotation rule. EY reported the breach to the UK's Financial Reporting Council and informed Shell. The result: the audits for Shell's 2023 and 2024 financial statements were no longer compliant. It's like a referee admitting they broke the rules after the game. Suddenly, the whole match is in doubt. Shell had to announce that those audit opinions couldn't be relied upon. The numbers might be right, but the official stamp of approval was invalid. This self-reported error triggered a regulatory investigation and a major headache for both companies. It's a costly lesson in why compliance matters. Shell is a global giant, listed on both the UK and US stock exchanges, which means it must carefully navigate and comply with two sets of audit regulations. This dual listing isn't just a formality, it brings real challenges as Shell must meet the strict requirements of both countries as financial watchdogs. When EY breached the partner rotation rules, it wasn't just a technical slip-up. The violation triggered consequences under both the UK and US frameworks, but the way each country responded was quite different, revealing how regulatory approaches can diverge even when the rules seem similar. In the US, the Securities and Exchange Commission enforces partner rotation rules with little room for error. As a result, Shell was forced to reissue its 2023 and 2024 audit opinions, this time with a new lead audit partner. This process is not only costly and time-consuming, but it also creates uncertainty for investors and stakeholders who rely on these financial statements. Meanwhile, in the UK, the breach was still considered a serious compliance failure. However, the UK authorities did not require Shell to redo its filings. Instead, the incident triggered a formal investigation by regulators, who are now examining how the breach occurred and whether further action is needed. This situation highlights just how complex global compliance can be, especially for multinational companies operating across borders. Even the largest firms with vast resources and expert teams can find themselves caught between conflicting or overlapping rules. EY's mistake didn't just cause a minor hiccup. It created a significant mess on both sides of the Atlantic, forcing Shell and its auditors to scramble to fix the situation and answer to multiple regulators. In the US, the fallout meant administrative chaos and urgent rework. In the UK, it brought regulatory scrutiny and the possibility of further sanctions or reforms. The UK's Financial Reporting Council is now investigating, aiming to uncover exactly how this breach happened and what changes might be needed to prevent it in the future. Ultimately, this is a powerful reminder. In global business, missing a single rule in one country can have ripple effects around the world, impacting companies, auditors, and investors alike. When a blunder like this happens, PR teams go into overdrive. The atmosphere is tense, with phones ringing off the hook and emails flying back and forth. Every word, every statement is carefully weighed, because the wrong message could make things even worse. Shell's official message is clear. Our business is stable, our financial numbers remain unchanged, and this is an issue for EY, not us. They want to reassure investors and the public that Shell itself is not at fault, and that their operations are running as usual. Internally, Shell's teams are working closely with auditors, cooperating fully with the investigation. They're updating financial reports and making sure every procedural box is checked, determined to fix the error and move forward without further damage. EY, meanwhile, is in full damage control mode. They've admitted the mistake, emphasized that they self-reported the issue, and are promising to cooperate with authorities. Their leadership is working overtime to restore trust and limit the fallout. Behind closed doors, EY's compliance teams are scrambling to review and overhaul their internal systems. They're determined to show regulators and clients that this was a one-off error, not a sign of deeper problems. The Financial Reporting Council, as the regulator, is keeping its cards close to its chest. While the investigation is ongoing, they're not giving away any details or opinions. Their official statement is brief. They're investigating EY's audit of Shell for a possible breach of partner rotation rules, and will share more when the facts are clear. For now, the FRC is gathering evidence, interviewing key people, and reviewing documents. Only after this process will they decide if penalties are necessary. Until then, the public gets only carefully crafted statements, while executives and stakeholders wait anxiously for the next development. The stakes are high: investor confidence, Shell's reputation, and the credibility of one of the world's biggest audit firms are all on the line. Everyone is watching, and the world is waiting to see what happens next. If Shell's numbers didn't change, why all the fuss? The issue isn't the numbers, it's the process. Like a scientist skipping steps in an experiment, an auditor breaking rules makes the result untrustworthy. The partner rotation rule is there to guarantee independence. By breaking it, EY invalidated its own audit, no matter the outcome. Investors rely on the process, not just the numbers. If EY missed this rule, what else might they have missed? It's about trust in the whole system. If a top firm can slip up, confidence in audits everywhere takes a hit. That's why regulators must act, to show these rules aren't optional. The integrity of the market depends on it. At its core, this is about trust, the foundation of the global economy. We trust banks, products, and companies because of rules and independent checks. Audits and their strict rules are the guardrails that keep the system on track. Partner rotation rules fight complacency and keep auditors skeptical and independent. Without them, cozy relationships can lead to unchecked mistakes or worse. Transparency is just as vital. Everyone needs reliable information to make decisions. When audit rules are broken, transparency and trust are damaged. Uncertainty creeps in, making investors wary and markets unstable. That's why regulators take breaches seriously, even if they seem technical. The FRC's investigation sends a message: rules matter, and shortcuts won't be tolerated. Upholding these standards is essential for public trust. In business, trust is the most valuable asset of all. So, what's next? Shell has already reissued its U.S. audit opinions and is cooperating with the investigation. They hope the story fades fast, but they'll be under scrutiny until the FRC wraps up. For EY, the fallout is bigger: a reputational hit and the risk of fines or public reprimand. The FRC will dig into how this happened. Was it human error, a system failure, or something deeper? The investigation could take months, keeping EY under a cloud. Other firms are now double-checking their own compliance to avoid a similar fate. For investors, the outcome will show how seriously regulators enforce the rules. The goal: learn from this mistake and strengthen the system. Trust in financial markets depends on it, and that's why this story matters far beyond Shell and EY.